Hi everyone, this is Michael Bengiat, and this is the Market Trend Advisory weekend video for March 12th, 2022. Before I start, I just want to have the disclaimer that the content and information in this presentation is provided for educational and informational purposes only, and in no way should be considered investment advice. And you can read the rest of that. Let's get right into the trend. Well, the trend has not changed over the last week. Market's still in a correction and in a downtrend. We have no positions on either for our indexes or for any individual stocks or non-index ETFs. The market count is 0 out of 5. The market exposure is 0%, and our power trend's off. So nothing's changed. The market is maybe even a little bit worse off technically than as we'll see in a few minutes. In terms of our new investing strategies, we have no exposure. We're still and you can see the returns. The QQQ is down 18.46% for 2022, and our market count 2x is down a little over 12.5%. For the SPY is down 11.79%, and our market count 2x is down a little over 12%. We actually haven't traded any of these yet because this is all brand new, and we started it just as when the market was already in a correction. Now we're going to be working on this market count 3x. Not happy with this. Is probably the lowest return, the worst return we've had since we went back all the way in 8.5 years. And I think it's because the market kind of ground its way lower in January and February, and it kind of just, because this is uses a lot of leverage, is using the TQQQ, it gave us some poor results there. Though of course it's flatlined just because we're not even in the market. So we're going to be working on a new version of this and testing things out, and that will be showing up probably within a couple weeks. So we're going to try to improve that, but while keeping the as much as we can of the fantastic return it had. So anyways, when we probably come back into a new market uptrend, we'll be using the market count 2x, which has been outperforming, and just has a little bit better overall drawdowns than the 3x, of course, because this has even more leverage. And we'll give you updates on that. And for the SPY too, the 2x will be continuing to use. The 3x was just too volatile as we tested it, but if we can get a new version of the QQQ, working with the QQQ, we'll get it we'll see if we can improve the SPY version too, and we'll add that on there. So before I start, I want to go into a little bit of what our system is doing and what's been really helping people to stay on the right side of the trend. So I know this is a little hard to see. This is our market trend advisory, as you know, the master big spreadsheet. And this is showing us basically from yesterday, which was Friday the 11th of March, all the way back to basically the beginning of January. And I've highlighted this column here, which is the Nasdaq-based individual stocks and non-index ETFs. This is our action signals. And I'll just kind of can't really read it very closely, but we've basically been out of the market, either no positions or just very small pilot positions for over 2 months now, 3 months now, going 2.5 months. And a lot goes into into our signals here. Has to do with how many stocks are breaking out. Are they holding their breakouts? Are they just kind of failing right away? Are the bases failing? How many stocks are setting up? And so this can actually vary quite often with what's happening with the indexes, and we've seen that a lot too. This actually gave us much more of a little early warning for the indexes in terms of their performance. So this has kept us out of a lot of the carnage. And right over here, I'm showing you this is just from Friday. These are a lot of the now former leading stocks. These stocks really, a lot of them drove the Nasdaq for years and years. We're talking, Zoom, we have Adobe Systems, we have Viva Systems, we have Roblox, we have Twilio, Roku, Peloton, that's probably one of the worst performers. Ring Central, here's one of the ARK funds, all these bargain outlets, BigCommerce, Fiverr, Coinbase. These are all names, if you've been a growth stock investor, these were all very high flyers The Trade Desk is a company I think is fantastic. It's hung in there a little bit better, but they're all getting just slammed. So you can see this is just on Friday. We're getting down 6, 7, 8, 9, 10% declines just Friday. So I wanted to show you, if you've been using this to help guide you through investing in individual stocks, by using this, you should have been basically out of it, even if you didn't heed any of the sell signals that these stocks have been giving off. So I want to show you, here's Netflix. I mean, this is just, we had a high of 700, we're down to 340. We're down over 50% on this stock just since December. And there were a lot of reasons why you shouldn't have been buying this. Definitely should have nothing to do with it now. Really, probably since here was where, if you were in it, you should have been getting out of it. A lot of sell signals broke here. And we triggered over here, and then now we broke below the 50-day. It's the black line. I mean, the 200-day. It's the black line. Here, the moving averages are just trending straight down. We had the death cross over here of the 200 and the 50. So this stock is broken. It needs probably months and months to try to bottom out and form some kind of a base and head up. So this is something that hopefully you're not part of, or if you had bought it even a long time ago, you're not giving up all of your gains. Actually, one thing we're going to be producing pretty soon, we're mostly through it, is a whole video course on selling rules. And we're also going to have one eventually of the buying rules and position management, things like that too. But the first one's going to be the selling rules, because it's always the hardest thing is to know when do you sell a stock. And really right here is where you should have been selling, especially probably right there. That was giving the sign that it was falling apart. I just want to show a couple other ones too, just because they're real similar. This is NIO, one of the, along with Tesla, this was really one of the most widely followed stocks with just huge participation. And we hit 55, and now we're down to 16, made new lows for the move in just on Friday. It's just, in fact, even if you've been buying it over here, you're already down 50% just from January. So that's how bad these stocks have been performing. Here's Viva Systems, another long-term stock. It had been on the long-term outperformer list for a long time, just outperformed for years and years, hit a high of 343. We're now making new lows at 174. And there's really no sign of any bottom in any of these stocks. And one final one here is Adobe System. This is one of the, sort of the blue chips stocks, and in terms of, this is a mega cap, and we're just down from 700 down to 415. So not quite 50% chop, but we're getting close, and also making new lows on Friday. So really, there's no signs of any of these things bottoming out. And so I think by using, if you'd gone back up here and we're using our signals, it was telling you for quite a long time, for months, the time was not being to be invested in stocks. So hopefully, if you are new to the system and hadn't been using this, or you kind of didn't use it as much as you could, we all learn, and we can use it going forward. I know for myself, I've been almost completely out of the market for a long time, except for trying a few little pilot trades in our stock picks service. Same thing, we just little tries here and there, but I think we've ended up with 7 losers in a row, and we lost our last one on Friday. But overall, I think our return was just minus 3% versus the Nasdaq's minus 17 or 18%, something like that. So we're outperforming, even though we'd rather be on the positive side, but we're very minimally down. So that's actually good. Okay, let's continue on to the trend here. This chart I've shown a bunch of times. This is the channel, and we broke above the upper part of this channel. And I'm going to give you a little zoom in here, so you can see here we actually broke below this channel, and looks like we're heading lower. Now the scary thing about this is that we don't really have a lot of support until we get to this 40-week moving average. This is a monthly chart, and that's about 16% lower than what it is right now. So that could be what the market is. When we would be in a pretty strong bear market, we'd be down, like 35–40% from highs. That's, after the huge bubble we had, it would be almost normal to have a big correction like that and be actually healthy for the market. So the S&P is holding up a little bit better. We have broken below the channel also, but it looks like it's getting support here at its 20-month moving average. That's this pink line. I don't have a zoom in on this one. So let's go a little closer look at what's going on. This is the Nasdaq, and you can see here's the day that we had our rally attempt. We had that huge up day. I think it was at 886 point day, and it was one of the largest day 1 point gains in like since 1971. So we're talking almost 50, over 50 years. So it was a huge up day, but really that's what happens in bear markets. You get these massive up days. We had another one over here, just open to the bottom and close near its highs. So that's bear market action. We had 2 of them here, actually 3 in a row. We had a open low, close to the high, open low, close to the high. A little dip, close to the high, but it really didn't amount to anything. And also the volume wasn't very good on that whole move. So, but what we're seeing now is we're getting a lot of institutional selling days. And those are just days where the market's closing lower on higher volume than the day before. And so we have 8 of them now. We're starting to get clusters of institutional selling days, and that's not a good sign. You can also see here that the relative strength is just heading lower too. It looks like we're almost made a new low, and we're not getting any sign of capitulation where you just have a massive volume day where the market just recovers. We're just not getting that. This was just more of a short covering, a relief rally. Any good news, we'll probably be doing that every time. If there's any good news, you'll see these kind of rallies appear. The market just seems to be grappling with too many issues to really get any traction. But that can change on a dime, and that's what the markets do. So here's the S&P. It's acting a little bit better. I don't have all the institutional selling days, but it's similar. I think there's maybe 1 or 2 less. But you can see, look at the volume. For here, it's just we're getting a lot more negative downside volume than upside. If I go back to the Nasdaq, it's just a little more pronounced on the S&P. So, which is maybe a little ominous too, because the S&P has actually been performing well because it has more of the cyclical and non-technology growth stocks. So here's a new chart we haven't shown before, and this is just the general markets showing the advanced decline line versus the index performance. This is the S&P up here. This is the Nasdaq. And you can see that the advanced decline line is just heading lower and lower, just showing there's less participation. The market's heading lower. You see this is the 50-day moving average and the black dotted line, and we've rolled over, especially on the Nasdaq. We're definitely on a downtrend there. So it's not a good picture at this point. Anything can happen. We'll talk about that in just a second. I just want to show a few more slides here. So here we are back at the sentiment. Nothing's really changed. We're basically in, with the CNN fear greed indicator, we're at panic. We've been stuck in solid red in the VIX for a long time. Normally the VIX is floating around 10 to 15, maybe up to 20. When you get above 20, we start getting red. This is really just solid red. And here we're getting panic and extreme fear. Strangely, the put-call ratio is not really spiking above 1, which is really where you start getting that panic. So it's been all year long, for about a year or maybe even a year and a half, has been very odd behavior on all these. So, but if you put them all together, especially with the Investors Intelligence weekly newsletter that comes out, we're getting the signs of a bottom. And this numbers over here we can see in this chart here where we've actually crossed, and the crossing has a pretty good record of catching bottoms. We had this in the bottom at the bottom of the coronavirus crash in 2020, and we've crossed again here. Now this correction, that was just a very quick here in 2020 because of the coronavirus. It was more of a crash that just quickly recovered when all that stimulus money, came into the market, or at least the Fed saying they're going to support the market. They're in a different position now. They're not really able to do what they were doing because now they're being forced to raise interest rates and not cut them. So that just gives us, again, a lot of cross currents. It doesn't look like this correction is going to be over just as quickly as the other one. We're already going on, I think, a couple weeks now in the correction, which is, looking over the data over 8 years, it's rare to have this long of a correction. Sometimes they're only 3 or 4 days. So just going forward, we still have the same kind of cross currents, but I think right now we have more issues for the market it's dealing with. So we have the Ukraine-Russia conflict, we have inflation, we have jobs, we have interest rates, and they're all front and center as investors' top worries. And so all that is actually just turning into extreme volatility and risk aversion on Wall Street. So again, like we mentioned last time, just be prepared for a sudden return to an uptrend. We are, I think, on day 15 or 14, I don't remember offhand, but it can happen any day. It's actually, we look for a follow-through day to come after day 4 of the rally attempt. So we're well within that range. So that could come any day now, or we could break to new lows. It does look like new lows are going to be the outcome because the markets are just acting really weak, but that could change if there's just a huge improvement in the Russia-Ukraine situation, or if the Fed decides, I think next week they're having a meeting where they're going to announce their interest rate increase. If they chicken out and decide not to raise it or do something different, maybe that could cause a huge rally. Whether those rallies will last, it's difficult to tell, because even if there's enthusiasm for a few days, the issues are not going away. Everyone's starting to see how much inflation there is. That doesn't seem to be changing yet. But the market does always look ahead. It's a discounting mechanism, and it may be seeing things if we do get a big uptrend starting again. It's seeing that it's not something that's going to last in inflation and it'll go back down, or whatever it's seeing. And just finally, one of the last things too is that individual stocks just continue to act poorly. It's just a really small subset of commodity and energy and shipping stocks. Really not. It's a poor market overall. That's all I can really say. So we're out and we're watching, and we're waiting for better times. They may come soon. They may come months from now. It'd be actually, as I mentioned earlier, it'd be almost healthier if the market just doesn't just roar back and actually has a chance to continue to wipe out a lot of the excess that happened over 2020 and 2021. And we'll see what happens. So we'll be back next weekend with the update for what happened during the week. And if you have any questions, always feel free to email me. It's michael@lifetimeinvestor.com. All right, thanks.